Hello and welcome back to Derivatives and Risk Education. Recently, in Lesson 10, we looked at yield curve bootstrapping. We saw how we can use this process to work out so-called discount rates from the market prices of coupon-paying bonds using no-arbitrage principles. The discount rate for a given maturity is the market interest rate for borrowing and lending from today to that maturity. Transactions starting today, or technically in 1 or 2 business days, are normally called spot transactions, so those discount rates are therefore also often referred to as spot rates. We will use this term of spot rate in this lesson to distinguish these rates from forward rates, which form the topic today. So, what exactly is a forward interest rate, or simply forward rate, in the context of financial markets? Simply put, it's an interest rate for a loan or investment that is agreed upon today, but for a period that begins at a specified time in the future and ends at another specified time. So to be clear, a spot rate is the market interest rate for a transaction agreed upon today and starting today. Forward rate is the market interest rate for a transaction also agreed today, but starting from some specified time in the future. Now we'll use a simple borrowing example to see exactly how no arbitrage conditions mathematically determine the forward rate from spot rates. Imagine you need to borrow 100 units of currency for 2 years. You have 2 ways you could do this. Strategy 1. You could simply borrow 100 now for the full 2 years at the current 2-year spot rate expressed as an annual rate. Let's call it R2. At the end of 2 years, your total repayment amount would be 100 times 1 plus R2 to the power of 2, as the rate is compounded annually for 2 years. Strategy 2. Alternatively, you could borrow 100 now for just 1 year at the current 1-year spot rate, R1. At the end of 1 year, you would owe 100 times 1 plus R1 to the power of 1, because it's just for 1 year. Also today, enter into an agreement to borrow this exact amount, 100 times 1 plus R1, 1 year from now for a period of 1 year at the 1-year forward rate starting 1 year from now. Let's call it F1, 2. So this is the forward interest rate for borrowing and lending transactions starting in 1 year from now and ending in 2 years from now. So in 1 year, you borrow 100 times 1 plus R1, and at the end of year 2, you would need to repay the borrowed amount plus interest at the forward rate. The total repayment at the end of year 2 for this strategy would be 100 times 1 plus R1 times 1 plus F1, 2 to the power of 1. Now the principle of no arbitrage states that the total repayment amount at the end of 2 years must be the same under both strategies. If strategy 1 resulted in a lower repayment, everyone needing to borrow for 2 years would use strategy 1. If strategy 2 resulted in a lower payment, people would use strategy 2. The market activity would quickly force the rates to a point where the outcomes are equal. So, under the no arbitrage condition, repayment from strategy 1 is equal to repayment from strategy 2. So these two amounts which we saw earlier have to be equal. We can divide both sides by 100 and rearrange this equation to solve for the forward rate. This is the fundamental no arbitrage formula for calculating the 1-year forward rate starting 1 year from now, derived directly from the fact that these two borrowing strategies must be equal in an arbitrage-free market. More generally, for a forward rate for the period between time little t and big T, where these could be any number of years after now, as long as big T is greater than little t, the no arbitrage condition applied to investing or borrowing over these periods gives us this formula. Here R little t is the spot rate for little t years, R big T the spot rate for big T years, and F little t big T is the forward rate for the period from little t to big T. This formula could be derived in a similar way to what we did for our example. Note in the formula the fraction is to the power of 1 over big T minus little t to get an annual rate. Let's put some numbers into this formula using hypothetical spot rates that we might have derived from market data in our bootstrapping lesson. As always, a spreadsheet with all the calculations is attached. Let's say the 1-year spot rate is 4% or 0.04 and the 2-year spot rate is 5%, 0.05. So here little t is 1 year and big T is 2 years. We have all the inputs for the formula. So the 1 year forward rate starting 1 year from now, strictly determined by the no arbitrage condition, given the current 1 year and 2 year spot rates, is approximately 6.01%. We can do this for any 2 points on the yield curve that we can derive from observable market data. Let's say we again have the 2 year spot rate at 5% and also a 5 year spot rate of 6%. We can calculate the implied 3 year forward rate starting after 2 years. So here little t is 2 and big T is 5. Again we can use the formula. Note we are taking the cube root to get the annual rate. So the 3 year forward rate starting 2 years from now is approximately 6.67%. Just like we can plot spot rates to get the spot yield curve, we can calculate and plot these no arbitrage forward rates for different future periods. This gives us what's called the forward rate curve. The shape of this forward rate curve is mathematically determined by the shape of the spot rate curve, based again on the strict no arbitrage relationship. If the spot rate curve is upward sloping, the forward rate curve will typically be above it and also upward sloping. If the spot rate curve is downward sloping, the forward rate curve will typically be below it and also downward sloping. In this graph we can see both the spot and forward rates from our two examples, with numbers we have seen before highlighted. I've extended the table and graph out to 10 years. Details for this are in the attached spreadsheet. Now, why are these market implied forward rates useful in finance? While their precise value is dictated by the no arbitrage condition from current market prices, they are often interpreted in ways that can inform financial decisions. One common hypothesis, known as the expectations hypothesis, suggests that these market implied forward rates reflect the market's consensus expectation of what future spot rates will actually be. Under this hypothesis, for example, an upward sloping forward curve would imply that the market expects future interest rates to rise, and an inverted curve implies that the market expects rates to fall. It's crucial to remember that this is just a hypothesis. Forward rates likely also include premiums, like liquidity premiums or risk premiums, demanded by investors for bearing certain risks or for giving up liquidity over different time horizons. So they might not be a perfect predictor of future spot rates. In the next lesson we're going to take this concept a step further and look at forward rate agreements, or FRAs or FRAs. You'll see how these derivatives allow market participants to transact based on these market implied forward rates. If you found this lesson helpful, please give it a like and consider subscribing to the channel if you haven't already. If you have any questions or comments, please leave them down below. Thanks for watching, and I'll see you in the next video.